four-parter. We're gonna go over the different ways to account for investments, and this first one is going to be trading securities. So let's go. Get the boring stuff out of the way first. So Accounting Standards Update 2016-01 was the latest update related to accounting for investments. Basically, that means trading securities are marked to fair market value, unrealized gains and losses are reflected in your earnings. Where do you find trading securities on the financial statements? They're going to be found on the balance sheet as a current asset. And you're also, if you have unrealized gains and losses, you will find unrealized gains and losses on your income statement. What are trading securities? They're going to be stocks. These are going to be publicly traded companies like Tesla, Google. These are going to be bonds, which are debt instruments that you can buy. This is going to be ETFs, mutual funds, which is going to be a collection of stocks and bonds that are managed by investment management firm. These are things you're going to find in trading securities. But also can be included are options, contracts, and rights. These can also be classified as trading securities. So why does GAAP have different categories for investments? Why can't we just lump them into one bucket? Well, you got to look at the time, how long you're going to be holding these securities. Two, you got to look at the intent. Are you purposely holding them for a short period of time, or are you intentionally holding them for a long period of time? And then you also got to look what type of security it is, because the type could automatically determine what bucket it goes into. All right, let's run through a scenario. You had trading securities, and we're going to mark them. So first things first, you need to recognize the purchase accounting related to buying the trading securities. In this example, January 1st, 2023, I bought these 4 securities. I'm going to debit trading securities, which is a current asset. I'm going to credit cash because I've used cash to buy these stocks. All right, we get a little farther down the road. My stocks have gone up in value, so now I need to recognize the unrealized gain for my first quarter financials. So at 3/31/2023, I'm going to debit trading securities to recognize the increase in value. In this scenario, they've gone up $185,000 collectively. And then the credit is going to be an unrealized gain that's going to show up on my income statement for $185,000. So that's how that works. Even though I haven't sold it, what GAAP is saying for trading securities is I need to adjust my balance sheet for the fair market value of those stocks. And based upon that increase in value, I need to recognize that gain on my income statement. Okay, so that's trading securities. That's buying them, recognizing the cost, and then marking them later down the road as they've gone up in value and hopefully not down in value, but that can happen. So the next part that we're going to cover related to investment classification is available for sale. Let's check that out so we can see what the differences are between trading securities and available for sale. This is part 2 of accounting for investments, available for sale securities. Let's go. All right, we're gonna start with the boring stuff again. Accounting Standards Update 2016-01 made a big change related to available for sale securities. Basically, equity securities are no longer going to be classified as available for sale, which just leaves debt securities being accounted for in the available for sale bucket. Now, when you're accounting for available for sale securities, you are going to adjust them to fair market value. However, the difference between trading and available for sale securities is when you make that adjustment to fair market value, you're not going to run it through earnings, aka the income statement. You are going to make that adjustment through other comprehensive income, which is going to be found on the balance sheet in the equity section. So where do you find available for sale securities on the financials? You're going to find it under the balance sheet again, and it's either going to be a current asset, but it also could be a non-current asset depending on what it is and what the time frame is. As I said before, you'll find the unrealized gains and losses related to available for sale securities also on the balance sheet, but that will be in the equity section under other comprehensive income, aka OCI. So what are available for sale securities? Now, we acknowledged earlier that equity securities have been scoped out of available for sale. So you're only going to have debt securities. That's going to be corporate bonds, muni bonds, US treasuries, preferred stock, any sort of debt that you have invested in can be treated as an available for sale security. Why is there multiple classifications for accounting for investments? Why can't we just lump them all into one bucket? Well, you gotta look at the time, how long you're gonna be holding it. You gotta look at your intention. And you also gotta look at what type of security, because as we acknowledged earlier, if it's an equity security, you're immediately gonna scope it out from available for sale. What I mean scope it out means you're not even gonna consider it. It can't be an available for sale security. How do you account for available for sale securities? So first things first, in this example, January 1st, 2023, I'm gonna buy these 3 debt securities. So the first thing I need to do is I'm gonna debit available for sale securities, and then I'm gonna credit cash for the purchase of those securities. So then later down the road, I get to quarter end, March 31st, 2023, I'm gonna adjust my available for sale securities to fair market value. So that instance, I'm going to debit available for sale securities, and then I'm going to credit other comprehensive income for my unrealized gains in this situation. And you'll notice in the income statement, there is no unrealized gains recognized. Everything's happening on the balance sheet. Now in this example, I am breaking up between current and non-current just to demonstrate with available for sale debt securities, they can be current assets, but they also could be non-current. You got to look at the specifics to see what the intent is, how long you're going to be holding them for, and determine is it really a current asset or is it a non-current asset. The fair market value adjustments is all happening on the balance sheet. It doesn't touch the income statement. That is the big difference between trading securities and available for sale securities. Okay, that's available for sale securities. You are going to adjust those to fair market value just like trading securities, but instead of it hitting the income statement, it's going to hit the balance sheet and other comprehensive income. The next category we're going to talk about is held to maturity. So let's go to part 3. This is part 3 of accounting for investments. We're going to go over held to maturity. ASC 320-10-25-1 classification of debt securities is going to define what a held to maturity investment is. All right, held to maturity securities are the easiest to account for because you keep it at cost basis. You do not adjust the fair market value of the debt security if it's held to maturity. Where do you find held to maturity securities on the balance sheet? Well, it can either be a current asset or it could be a non-current asset, depending on when the debt security matures. If it's within a year, you're going to put it in the current portion of your balance sheet. If it's further out than a year, you're going to put it in the non-current portion of your balance sheet. What are held to maturity securities? I'm sorry that rhymes so often in this. It is going to be a debt security. It's only debt securities. It cannot be equity. It is going to be a debt security like a bond, a US treasury, a muni bond that you are planning to hold until the bitter end of when that debt security matures. If you plan to sell it before it matures, it cannot be classified as held to maturity. So why does GAAP have all these different classifications for investments? Well, you got to look at the underlying details. You got to look at what type of security. You know, with equities, you're going to get scoped right out of held to maturity. You got to look at the intent. Are you planning to hold this debt security until the bitter end? If you're not, you're definitely not going to put it in held to maturity. And then you got to look at in this case, you got to look at the ability. Do you have the ability to hold this debt security to the bitter end? Because if you don't, then you're not going to class it as held to maturity. So what's the accounting for held to maturity securities? Well, it's going to be very easy. You're going to buy your securities, so you're going to debit held to maturity investment, and you're going to credit cash. Outside of that, you're not going to do anything. You are not going to adjust it to fair market value. You are only going to recognize the interest income as it comes in. You're not going to recognize a gain or loss on this until you actually sell it. So until you sell it, there is no adjustment. It just stays on your balance sheet at cost. Okay, that is held to maturity debt securities. It's very specific. You got to show intent and ability, and more than likely this is not going to be the classification that you choose, but if you meet that criteria, then you can account for that particular investment at cost basis instead of fair market value. Our next topic for investments, our last one, our part 4, is going to be equity method. This is very different from the other 3, so stay tuned for that one. Part 4 of our investment series, how to account for equity method investment. We got some accounting standard codifications to get through. I will get through this as quickly as possible. We'll get the boring stuff out of the way, but this is a little bit more technical than the other types of investments we've covered so far. So ASC 320-10-15-3 is going to be related to stock-based investments. So this is going to be corporations. And just to clarify, equity method is only for equity investments. It's not for debt investments. So if you have a debt investment, you could automatically just eliminate equity method accounting from that situation. You need to be able to exercise significant influence, which means you have the ability to influence the results, the operations. You can have opinions on how that company is being run. Now, when you originally buy the investment in the corporation, you're going to recognize that as cost. Also, ASC 323-10-45-1 is going to go over equity method for partnerships, LLCs, limited liability companies, and joint ventures. It's going to follow the very same procedure that we're going to go through next. So with equity method investments, earnings of the company that you have invested in are going to increase your investment pro rata to your ownership, and then dividends that you receive from that investment are going to reduce your investment basis in that company. Where are equity method investments found on your financials? One, on the balance sheet, you're going to find that as a non-current asset on the balance sheet, and also you're going to find equity income on your P&L or your income statement related to your pro rata earnings of your investment. What are equity method investments? They're going to be corporations, partnerships, limited liability companies, JVs, not debt. You're not going to find debt anywhere with equity method investments. Why are there multiple classifications of investment accounting? Basically, you need to look at what type of investment it is. Is it equity? Is it debt? You got to look at timing. How long are you going to hold this thing? And if you have an equity method investment, you got to look to see if you have significant influence, whether you have that or not, or do you have controlling interest, because that's going to be a totally different set of accounting rules related to consolidation. So what is the accounting related to equity method investments? Well, first, we're going to use PBC LLC as an example. We're taking a 20% interest in that company at $1 million investment. So in that situation, you're going to debit your investment and you're going to credit cash. And then later down the road, once you get a P&L or an income statement from your equity method investment, PBC LLC, you're going to recognize your pro rata portion of earnings to increase your investment. So in this situation, we have $200,000 of net income from PBC LLC. We have a 20% interest. That is $40,000 of equity income we're going to recognize, which $40,000 is going to increase the value of our investment on the balance sheet. And then you're also going to recognize $40,000 of equity income on your income statement. That's how that works. Also, if you receive a dividend or a distribution later down the road, that is not going to hit your income statement. That is just going to reduce your investment in PBC LLC. Okay, that's equity method investments. Basically, in this situation, you're going to recognize your pro rata portion of earnings in your results, and you're going to reduce your investment for any dividends and distributions that you receive along the way. And if you have not watched my other investment accounting videos, I got trading securities available for sale and held to maturity. Go check those out as well. They're going to be super helpful.